Stock market trading. Level 1. Intraday trading. Intraday trading. Intraday trading involves buying and selling of stocks within the same trading day. Here, stocks are purchased not with an intention to invest, but for the purpose of earning profits by harnessing the movement of stock indices. Thus, the fluctuations in the price of the stocks are harnessed to earn profits from the trading of stocks. An online trading account is used for the purpose of intraday trading. While doing intraday trading, you need to specify that the orders are specific to intraday trading. As the orders are squared off before the end of the trading day, it is also called intraday trading. Intraday trading deals with buying and selling of stocks on the same day, during the trading hours that are stipulated by the exchange. Stocks are bought and sold in large numbers strategically, with the intention of booking profits in a day. Let's explain intraday trading with an example. Suppose that you've bought 100 stocks of ABC Limited during the open market hours. Then you have to sell the same number of stocks of ABC Limited before market closure. Same is the case if you have sold the stocks. You have to buy the same quantity of stock you have sold earlier. How to go about intraday trading. It is important to understand the fundamentals of intraday trading in order to make consistent profits. A good tip is to trade with the current market trend. If the market is falling, sell first and buy later, and vice versa. Make an intraday trading plan and stick to the plan. Set your desired profit and stop loss limit. Do not be greedy. Instead, book your profits at regular intervals. Maintain stop loss levels. It helps you to limit your loss if the market does not perform. Also, choose highly liquid shares and trade in small number of shares at a time if you are not a seasoned trader. Basic rules of intraday trading. An unexpected movement can wipe all your investment in a few minutes. Hence, it is important to keep in mind a few intraday trading basics while carrying out intraday trading. Do not trade in the first hour, as the opening range is established during that time. The fluctuations of this range can help to identify the intraday trend. Move with the market trend, as it allows potential for a greater profit if the trend continues. Another basic rule is to fix entry price and target levels. Set a stop loss limit so that your losses will be curtailed if the share drops. Also, withdraw if your desired profits are met. Stick to your plan and carry trade in a disciplined manner. Here are a few takeaway points to keep in mind while doing intraday trading. Intraday trading tips. Intraday trading is riskier than investing in the regular stock market. It's important, especially for beginners, to understand the basics of such trading to avoid losses. Individuals are advised to invest only the amount they can afford to lose without facing financial difficulties. A few intraday trading tips will help you learn the art of trading. Intraday trading indicators. When it comes to booking profits in intraday trading, you will require to do a lot of research. For the same purpose, you'll need to follow certain indicators. Often intraday trading tips are believed to be the holy grail. This, however, is not entirely accurate. Intraday trading indicators are beneficial tools when used with a comprehensive strategy to maximize returns. How to make profit in intraday trading. Intraday traders always face inherent risks that exist in the stock markets. Price volatility and daily volume are a couple of factors that play an important role in the stocks picked for daily trading. Traders must not risk over 2% of their total trading capital on a single trade to ensure the right risk management. Intraday time analysis. When it comes to intraday trading, daily charts are the most commonly used charts that represent the price movement in a one-day interval. These charts are a popular intraday trading technique and help illustrate the movement of the price between the opening bell and the closing of the daily trading session. How to choose stocks for intraday trading. To succeed as a day trader, it is important to know how to pick stocks for intraday trading. Often, people are unable to make profits because they fail to select appropriate stocks to trade during the day. Choosing the right stocks to book profits is an art that you will learn with experience. Price gaps. A price gap is a change in price levels between the close and open of 2 consecutive days. Although most technical analysis manuals define the 4 types of gap patterns as common breakaway, continuation, and exhaustion, those labels are applied after the chart pattern is established. That is, the difference between any one type of gap from another is only distinguishable after the stock continues up or down in some fashion. Although those classifications are useful for a longer-term understanding of how a particular stock or sector reacts, they offer little guidance for trading. For trading purposes, we define 4 basic types of gaps as follows. A full gap up occurs when the opening price is greater than yesterday's high price. In the chart shown here for Cisco, the open price for June 2nd, indicated by the small tick mark to the left of the second bar in June, is higher than the previous day's close, shown by the right side tick mark on the June 1st bar. A full gap down occurs when the opening price is less than yesterday's low. The chart for Amazon shows both a full gap up on August 18th and a full gap down the next day. A partial gap up occurs when today's opening price is higher than yesterday's close, but not higher than yesterday's high. The next chart for Earthlink depicts the partial gap up on June 1st and the full gap up on June 2nd. A partial gap down occurs when the opening price is below yesterday's close, but not below yesterday's low. The red arrow on the chart for offshore logistics shows where the stock opened below the previous close, but not below the previous low. Summarily, price gaps occur when a security's opening price differs from the previous day's closing price. When the opening price is lower than the previous day's closing price, it is known as a gap down. When the opening price is higher than the previous day's closing price, it is known as a gap up. Price gaps can occur because of company announcements, market announcements, news, etc. Gap trading strategies. The 8 primary gap trading strategies are as follows. Full gaps, full gap up, long. If a stock's opening price is greater than yesterday's high, revisit the 1-minute chart after 10:30 a.m. and set a long stop, 2 ticks above the high achieved in the first hour of trading. Full gap down, long. Poor earnings, bad news, organizational changes, and market influences can cause a stock's price to drop uncharacteristically. A full gap down occurs when the price is below not only the previous day's close, but the low of the day before as well. A stock whose price opens in a full gap down, then begins to climb immediately, is known as a dead cat bounce. If a stock's opening price is less than yesterday's low, set a long stop equal to 2 ticks more than yesterday's low. Full gap down, short. If a stock's opening price is less than yesterday's low, revisit the 1-minute chart after 10:30 a.m. and set a short stop equal to 2 ticks below the low achieved in the first hour of trading. Partial gaps. The difference between a full and partial gap is risk and potential gain. In general, a stock gapping completely above the previous day's high has a significant change in the market's desire to own or sell it. Demand is large enough to force the market maker or floor specialist to make a major price change to accommodate the unfilled orders. Full gapping stocks generally trend farther in one direction than stocks which only partially gap. However, a smaller demand may just require the trading floor to only move price above or below the previous close in order to trigger buying or selling to fill on-hand orders. There is a generally greater opportunity for gain over several days in full gapping stocks. If there is not enough interest in selling or buying a stock after the initial orders are filled, the stock will return to its trading range quickly. Entering a trade for a partially gapping stock generally calls for either greater attention or closing trailing stops of 5 to 6%. Partial gap up, long. If a stock's opening price is greater than yesterday's close, but not greater than yesterday's high, the condition is considered a partial gap up. The process for a long entry is the same for full gaps in that one revisits the 1-minute chart after 10:30 a.m. and sets a long stop 2 ticks above the high achieved in the first hour of trading. Partial gap up, short. The short trade process for a partial gap up is the same for full gaps in that one revisits the 1 minute chart after 10:30 am and sets a short stop 2 ticks below the low achieved in the first hour of trading. Partial gap down, long. If a stock's opening price is less than yesterday's close, revisit the 1 minute chart after 10:30 am and set a buy stop 2 ticks above the high achieved in the first hour of trading. Partial gap down, short. The short trade process for a partial gap down is the same for full gap down in that one revisits the 1 minute chart after 10:30 am and sets a short stop 2 ticks below the low achieved in the first hour of trading. If a stock's opening price is less than yesterday's close, set a short stop equal to 2 ticks less than the low achieved in the first hour of trading today. If the volume requirement is not met, the safest way to play a partial gap is to wait until the price breaks the previous high or low. Trading system. Example with S&P 500. A trading system is a group of specific parameters that combine to create buy and sell signals for a given security. Trading systems can be developed using many different technologies, including Microsoft Excel, MATLAB, TrainStation, R, Python, and other platforms and languages. The buy and sell signals from these platforms may appear in a file for you to execute or be programmatically executed using a brokerage that supports automated trading. There are countless different inputs that can be used when building trading systems. Technical indicators are the most common, but many trading systems incorporate fundamental data such as revenue, cash flow, debt to equity, or other financial ratios. Others even incorporate news, tweets, and other data from around the web that could provide a signal. The only requirement is that the data must be represented in a way that a computer can analyze. A trading system is a set of rules that can be based on technical indicators or fundamental analysis. A trading system tells the trader when and how to trade. In many cases, a trading system is like a blueprint for trading. A trading system is important for a trader because without it, there is no way a trader can expect to trade. Despite getting lucky a few times, one cannot expect to remain consistently profitable without following a trading system or a strategy. Gap and go. The gap and go strategy is when a stock gaps up from the previous day's close price. If you're looking to do gap trading successfully, then the most common strategy is to use a pre-market gap and go scanner and search for stocks that have volume in the pre-market. Gap trading rules. Here are 4 rules to keep in mind when you have a gap. A gap up in price into supply after a rally in price and in context of a downtrend is a very high probability shorting opportunity. A gap up in price and in the context of an uptrend is a lower probability shorting opportunity and can actually be a buying opportunity on a pullback to demand when there is a significant profit margin above. A gap down in price into demand after a decline in price and in context of an uptrend is a very high probability buying opportunity. A gap down in price and in the context of a downtrend is a lower probability buying opportunity and may, in some cases, be a shorting opportunity after a rally into supply when there is a significant profit margin below. Other rules include gap larger than 3%, daily volume greater than 2 million shares, use 1-minute candles, risk equals reward 1 to 1, 75% partial of 400 shares or more, ignore dual traded stocks.